Good morning. It's Jeffrey Christian of CPM Group. It's about 11:20 in the morning here in New York, Friday the 24th of March. I wanted to talk about Russia's gold holdings this week. It's an issue that has been uh, around in the market for some time. There have been rumors over the course of the year that the Russian central bank was selling gold into the market, either through other central banks or to other central banks, and also to some trading companies that were perhaps willing to skirt the sanctions against trading with the Central Bank of Russia. The central bank itself stopped publishing its international monetary reserves data, including gold, after early February of last year. In February of last year, it published its data for January reserve levels, and then in early March, it had already attacked Ukraine, and it stopped publishing the data. But it has come up with the data, and this chart here shows you the Central Bank of Russia's monetary reserves data. It does exclude the small amounts of reserves that are in special drawing rights and in its reserve position in the International Monetary Fund. So very small amounts, but it shows you the total of monetary reserves at the central bank. And you can see they basically declined. They declined in September. They came back up a little bit, and then they were declining again in February of this year. The orange line is the foreign exchange holdings, and it's a little over $400 billion right now. And much of that is either frozen through sanctions or is being held by central banks that have not made those reserves available to the Russian central bank because of the sanctions and not wanting to be sanctioned themselves. So about a third of the $450 billion that the Central Bank of Russia had in January, February of 2022, about a third of that currency was in yuan at the People's Bank of China. And when Russia invaded Ukraine and other central banks froze the assets of the Central Bank of Russia, freezing up about $300 billion of foreign exchange reserves, the Russian central bank asked the People's Bank of China for its money back. And the People's Bank of China, at least initially, and I believe still, said, listen, if we trade with you and give you your money, we run the risk of having sanctions applied to us. So while we're not sanctioning you and we're not freezing your assets, we're not giving you access to them. So it's not clear how much of that $400 billion is actually available. Obviously, after the sanctions were put in place and the assets were frozen, the Russian central bank changed its policies, and it started holding the inflow of foreign exchange reserves after February of 2022. It still started holding new reserves it was had coming into its coffers elsewhere, where they weren't at risk of sanctions and being frozen. You could see a decline in foreign exchange reserves, and it's interesting. I don't have the table here, but there was a very interesting chart a few weeks ago that I saw, which was the payments settlements for imports and exports and capital flows into Russia, broken down by currencies. And the bulk of it is still in U.S. dollars, although the Russian central bank says they don't want dollars and they don't want euros. They're still winding up doing most of their trade in dollars and secondarily in euros. And then they have those converted to rubles or other currencies. Their yuan-denominated trade has risen, but it's still far less than 10% of the settlements in Chinese yuan. And the gray line at the bottom are their gold holdings in U.S. dollar, billions of dollars. something that a lot of people probably don't know is that when central banks report their gold monetary reserves to the International Monetary Fund on a monthly basis, they report the dollar value. And the IMF will use that central bank's gold valuation method to convert the dollar value of those gold reserves into ounces. So it's a calculated number of ounces. But this is the dollar value. And you can see slight decline and then a little bit of a pickup, and it's a down. Let's look at the actual gold. As I said, there had been rumors over the course of the last 13 months during the war that the Central Bank of Russia was in fact selling gold into the market, into the international market, or to other central banks. And what we see here is a very volatile change in the level of gold calculated using their dollar values and the London PM fixed price on the last day of each month. And you can see they rose a little bit in the first few months of the war, and then they would rise and then they'd fall. You'd see a couple million ounces being purchased. I've got the table over here. A couple million ounces being purchased in May, and then it'd be sold in June. Again, you'd see a purchase in July, and then it would be sold again in August. So what you saw was that given the sanctions and the frozen foreign currency assets, the central bank has been using gold to generate foreign exchange. And so they will buy gold from domestic refiners, and then they will sell it to somebody. There is a lot of demand in the private sector in Russia for gold, and Russian investors and consumers and individuals are paying pretty high premia for gold investment products because they don't want to hold so much of their money in rubles right now, given the state of domestic and international politics in Russia and the war. And you can see that there has been some sales and then some purchases, but it's been very volatile. Some of you have heard us talk about monetary reserves of gold in the past, and we've talked about how various central banks will have a trading reserves of gold that are distinct from their monetary reserves. And they'll do that for a variety of reasons, but one of the things is they want to show a stable monetary reserve level. Central Bank of Russia is not doing that. When they have gold and they buy gold, they add it to their monetary reserves. And then when they need it for foreign exchange, they sell it and reduce their monetary reserves. So we've seen this going on. You can see that the Central Bank of Russia, as of the end of February this year, had slightly more gold in its coffers than it did at the onset of the war at the end of February 2022. I mentioned a few weeks ago when I was talking about central bank gold, I said, there are people who keep talking about how central banks are rushing into gold. But when you look at it, over the course of 2022, there were only 8 central banks out of 180 plus or whatever that had bought more than 600,000 ounces of gold. 7 that had bought more than 1 million ounces of gold. So there were only 606 central banks that bought significant amounts of gold. There were 21 central banks that were net buyers of gold last year, but only 6 of them were buying 600,000 ounces or more. The value here, the change here is about 500,000 ounces year over year, February to February. So Russia was a little bit below that threshold. But the point I made talking about other central banks was that there wasn't a broad-based rush into gold. 6 of the 8 central banks that bought significant amounts of gold last year were Islamic government central banks or monetary authorities. The seventh was India, which has a large Muslim population that has a lot to do with gold supply and demand and attitudes within India. And the eighth one was China. So of the 8 banks, 6 were Islamic. And I said, the question's not so much why are central banks buying gold as it is what's going on in the Islamic world that is causing Islamic central banks to buy gold. I bring that up here because you can make the same question about the Central Bank of Russia. What has happened that has caused it to publish its international monetary reserves, foreign exchange as well as gold, now having suspended those reports and kept that information from public disclosure for 12 months? That's probably a much more important question than the question of why has the Russian central bank have more, 500,000 ounces more gold today than it did at the start of the war. That's kind of self-explanatory. But the real question is, or the really interesting question or answer would be, why are they making this a disclosure now? I don't have an answer. It's an interesting topic, though, and I'll talk about it in a second. Meanwhile, the gold and silver markets. To say that the past week has been interesting is to use British understatement. We have seen Credit Suisse absorbed by UBS because of financial problems. We've seen 3 regional banks in the United States have issues and have sales due to those issues. We've seen the FOMC raise interest rates another 25 basis points the way they told the markets and the way the markets should have expected it. We've seen large changes and shifts in interest rates and in bond prices and in the stock market. Gold prices and silver prices have risen very sharply as well. And you can see gold prices right now are a little over $2,000 as we record this, and silver is over $23. So we've seen the prices rise. Now, CPM Group has warned its short-term investment-oriented clients that we think that at some point some of these pressures will dissipate and the prices will fall back. So we had been saying, go short or stand aside if you don't want to be short these markets right now. And we've been wrong for the last week. The prices have risen further. We still expect the prices to decline, and we still expect the risks to dissipate, or the perceptions of financial market risks and economic risks to dissipate some over the second and third quarters. We also still expect those risks to resume being problematic in the minds of investors, which will lead to stronger investment demand for gold and silver and higher prices, possibly starting as early as the fourth quarter of this year. But right now we're saying, look, this is probably a temporary overexcitement on the part of people who are buying and shifting money into gold and silver, and you should expect it to dissipate. And I want to show you, these 2 charts are gold and silver prices really since the beginning of 2022. And the reason I want to bring it is you can see the first quarter of 2022 when the gold price went from around $1,800, $1,840 an ounce up to $2,060, and then declined from March of last year into the beginning of November. And I point that out, and you saw a similar pattern in silver. I point that out too because if you go back to March of 2022, the Russians had invaded Ukraine. There were any number of other issues that were facing the world and the world economy. And people saw the gold price go from $1,840 to $2,040, $2,060, and they were convinced that the price of gold and silver would continue to rise. And then for the next 7 months, they fell. And I just want to point that out because, yes, there's some seasonal demand issues with fabrication demand and investment demand. And there are other factors there too. We would caution people from being too enthusiastic. And we would say, we do think that you are in the foothills of the financial crisis we've been expecting to emerge. For about 5 or 6 years, we've been saying we thought that it would emerge in 2024, 2025. And we're still saying that. And we think that you're seeing a spurt higher in gold and silver prices now that will probably dissipate for several months over the middle part of this year before heating up again when we're further up the road. Similar pattern we talked about earlier in the week. In 2008, we had a financial crisis that was starting to grow. We had a global financial crisis was starting to emerge. You had a lot of issues with collateralized mortgage obligations. Bear Stearns, which was very heavily long, they were not a commercial bank. They were an investment bank, so they took unhedged positions as an investment. And they were long and wrong, and they suffered mightily and were taken over in March of 2008. Price of gold spiked sharply higher, got over $1,000 for the first time. And then within 2 or 3 months, it was below $900. And it actually stayed low for some time until September, really, when Lehman Brothers went bust. Another non-commercial bank. It was an investment bank. Came under different laws and rules and regulations. And you started seeing things get much worse in September and October of 2008, and the gold price started rising again. So you can see these kinds of patterns. From a longer-term perspective, yeah, we think the prices of gold and silver are likely to rise over the next 2 or 3 or 4 years. But over the next several months, we would suggest that investors be a little bit cautious about curbing their enthusiasm. We will be releasing our gold yearbook next Tuesday. This is, again, last year's report. This year's report is being paginated as I speak to you on Friday morning. We will have a briefing at 10 a.m. It's free and open to the public. You can go to our website and find a place to register for it. And you can find a place to buy and pre-order the gold yearbook. It comes out as an ebook, so you'll get it distributed to you via email next Tuesday on the release. It's $160, and it will give you a lot of information and data and statistics and analysis that will help you be much more better informed and accurately informed on the gold market than you will know from the stuff you get free from people who market gold. Next Tuesday, 10 a.m. Eastern Daylight Time. We'll do that. That's Rohit Safan, Carlos Sanchez, my business partners and analysts and advisors here at CPM Group. We'll all be on that. Then the following week on April 3rd, we will have a open forum for our clients. Again, YouTube, free to our clients. They can plug in. They can send us questions and topics they want us to discuss ahead of time so we can prepare for it. Or they can ask us questions during the event. That's at 11 a.m. Eastern Daylight Time on Monday, the 3rd of April. And we will be addressing those issues then. That's what I have for now. Take care of yourself. Have a good weekend. See what you can do to make the world a better place. And we'll talk to you next week. Bye.